Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter again, see what people are talking about, go over some technical analysis charts that they have on Twitter. It's going to be finance related, commodity related, precious metals, or wealth building, and real estate, I should say. So let's dive in there. I'll give you my financial opinions on what's going on. Again, it's at finding_finance if you want to follow me on Twitter. And if you want to join the website, we're coming up to the last days to join with the 50% discount using the happy birthday discount code. So get over there, sign up if you want to. Use that code for 50% off the first month, and you can try it out. So the Gladiator says the coming lithium copper bull market will be frightening. The closed door conversations happening in boardrooms involving lithium and securing supply of lithium is like nothing seen in Australia in the past 50 years. Guys, this is going to get super tight. All you have to do is sit in it and wait. Sit in it and wait. A lot of the charts have broken to the upside for commodities. If you take a long-term approach to things, long-term being a couple years, I think it's going to work out very well for those who take the couple-year approach. And you just sit in these undervalued assets across, I don't know, maybe 4, 5, 6 different sectors that are all inflecting positive, very cheap. Their ratios are they're turning positive for the cheap asset against other assets. It's how you make your money. It's a great strategy, but you have to be patient enough for it to work. A quarter, 3 months worth of waiting is not nearly long enough. You have to extend it out for years, because you could have bottoming processes that take a few years to bottom out and really start to get moving. The majority of the moves usually occur towards the end of the market, but on the big percentage gains, they can happen at the beginning of the market because the prices are so low and mispriced. So you get kind of the two big moves through the waves of the Elliott wave cycle. Here's Don. I don't know if I agree with it. He says the housing market's strength is a mirage driven by record low activity. A few transactions at elevated prices keeping the illusion of a sound market alive, and new home builders generating 20% plus of sale activity right now with their ability to offer incentives and buy downs. I think that viewpoint is drastically wrong. You cannot be in a bubble with no inventory. All of the people that have these types of viewpoints, they refer back to time frames in history where we're tripping over each other in inventory. The demand is gone and the inventory is plentiful. Problem is the demand is plentiful, but they're being priced out through interest rates, and the inventory is gone. So when the inventory is gone, you know where they're going to run? They're going to run to new home builders. That is what he's seeing. He's seeing that we're in the middle of an expansion phase of real estate. He just doesn't know it. He doesn't realize it. And the majority of people who are looking at the real estate market, they don't realize that we're in the thick of a millennial home buying spree, and interest rates are the only thing slowing this whole thing down. So could inventory come back? Yes, it could, but the problem is it's going to take time for that to come back and we would see it. So the bubble crew, in my opinion, is just flat out wrong at this point. They're too early to make that call. Now, if we saw existing inventory, really start to skyrocket, then I would join their camp. Problem is, we just haven't seen it. So I think you're going to have to wait for that to occur to start coming out with this. Now, sure, you can throw these things out. That could be an opinion, but that opinion does not match previous previous times in history where inventory levels were through the roof. This is another one too. Amy seems to be pretty mixed up on her opinions, in my opinion. Bloomy's out swinging with the hot housing take on Monday morning. Let's check and see what they said last cycle. So this is what they said last cycle. Just because Bloomberg got it wrong last cycle doesn't mean that they're wrong here. to take this type of analysis, and this is kind of like the analysis of evaluating the correctness or the accuracy of individuals trying to predict how recessions or housing bubbles or stuff like that. Um, what causes the prediction to be right is looking at the right data. This here is not looking at data. You're just looking, oh, well, they got it wrong last time, therefore it's going to be wrong this time. I think that is completely illogical thinking. That's not rational thinking. Rational thinking is, okay, in 2007, we had massive inventory of homes. Okay, do we have massive inventory of homes? No, we don't. Okay, well, that's a big difference. And to not know that, I mean, you're kind of on the short bus level there. I mean, it's like, oh my gosh. The conditions are what determine the pricing. And the pricing will go down based off those conditions. So are the conditions same in 2007 that we have today? No, they're not. And that's really all that you have to ask. Scrolling down, we've got Grady here, XAU larger gold miner. So looks good, very big picture. It has a second equally sized blue inverse head and shoulders, which has had a hard back test. Its measured move is up at the pretty 40-year pink megaphone upper trend line. Could get a swift reverse symmetry move up there. That's XAU, which is gold on a quarterly 40-year line chart. He takes a chart, throws it on the top, throws it on the bottom, and we could potentially be moving up with an inverted shoulder head shoulder, inverted shoulder head shoulder. What this is telling us is that we could see inflation coming. The gold market thinks inflation's coming. Technical analysis, the reason I like it so much is because it's an unbiased viewpoint of the market, and you're gaining the market's opinion by looking at chart patterns that humans scribe out when they trade together. So what I find it very hard to believe, you get these like how the real estate market people that were saying, oh, it's a bear market, right? Well, if you look at the gold market, you look at a lot of the commodities market, what they're signaling is inflation is coming. I mean, yeah, everyone else who's looking at the lagged indicators of PPI, CPI, those are all lagging indicators. The leaders is how people are positioning in inflation sensitive assets. You could say platinum's inflation sensitive, oil's inflation sensitive, along with gold. Gold is as well. The accounting is being done right now that we are printing more money. That inflation is probably going to come given these chart patterns. It's hard for me to believe that real estate's going to go down in an inflationary period, which I don't think it's ever really done that. So to say that we're in a housing bubble and inflation's coming based off of all the commodity charts, someone's wrong. And we're going to find out, obviously. I mean, obviously, I'll change my opinions if inventory skyrockets. I'll change my opinions if all this stuff starts to put in crappy chart patterns. But the problem is everything looks good to go higher, which is inflation. The home builders, they're all going higher. It is dangerous to ignore all of those signals. To become a very good investor, you need to take in those signals. You need to take in the chart patterns. You need to weave whatever the patterns and the market is telling you to weave. That's the story you weave. It's like, if these are going up, inflation's most likely coming. We're hitting a second wave of inflation. It's not an opinion. It's not guessing. It's not, oh, the index is expensive. Expensive doesn't mean crap. Expensive means that you could be in the largest shortage of homes that you've ever had in your life. And guess what? I would expect the inventory to be low. I would expect the affordability to be crappy. And I would expect the Case-Shiller index to be at a very high level if we were in that type of market condition. And that's what we're in. So all these are looking good. Now here's one with Adam. He says, do you have a financial plan? Projecting out your net worth is expected to grow over the coming decades, given your expected earnings, expenses, and investment returns. If yes, have you revisited it recently to ensure it's up to date? If no, why don't you have one? I don't have one at all. I think it's a complete waste of time. My expenses have been, they were stable, but they're fluctuating all over the place. My investments are highly dependent on what the returns are not steady like you would be in a bond return. They're fluctuating all over the place. I didn't have too much investments even 10 years ago, and I could easily blow this out of the water in the next few years. I've fully adopted the ratio strategies, I would say, the past few years after realizing what's driving all these cycles, which is the real estate cycle. So I've probably been in it for about 5 years. My returns have been absolutely ridiculous. I would have never guessed my returns to be that high. Um, and I don't. It's hard to project and do that. I don't think it's worth it if your accuracy is not even within. I probably can't even get within 50%. I probably can't even get within like a 2 or 3x of where I'm going to be. I have no idea. And that's why I don't do it. I do map out how much I want to save. That is really all I try to project. I don't try to project where my net worth will be. I could be worth $10 million in a few years, depending on how the commodity markets go. And and to project that, I don't see that as being a huge benefactor. What benefits me is how much money do I want to save, and what do my expenses look like. Those are things I can control. I can't control if the market goes up and down. I can't control if commodities are going to take off today or 5 years from now. To project that, I think it's not worth it. What you want to do is you want to get situated in the most undervalued, largest asymmetric plays, sit in them, and wait for them to materialize under the right market conditions. Your expenses is really the form that you can control. And that's where I focus my efforts. Where are my expenses at, and how can I keep them under control? That's where I spend my time. Things that I have control over. Here's Grady. He says, big picture, there's now a huge divergence between gold and TLT, which is the 20-year bond price. Either something has to give here, or US bonds are broken. And if US bonds are broken, that should leave a mark. I'm in the later camp, guys. I'm starting to think that bonds are done. I'm starting to think that we could have a currency crisis at some point, and gold's going to account for it while interest rates go up and the bond market eats it. That means you're going to see a large rotation of money out of bonds, and that's exactly what we're seeing in this divergence here. Before, when we were linked under a declining interest rate environment, gold and the bond prices were linked up. Now it's all breaking apart, which I think is positive for commodities and gold. Grady again, silver's up against that big blue breakout line. Get ready for a huge big move. Second secular bull leg started at March of 2020 crash lows. Once the blue line is broken, huge gains are coming. We're all extremely fortunate seeing this and having the tools to make the most of it. Historical opportunity. Don't blow this, guys. This is your big flag pattern. Started in 2000. There's the flag. The projected flag move. I don't know, a couple $100 or something like that. It's going to be big. We got Tavi here. So this is a little bit different sector here. He says the relative performance of the healthcare sector versus the S&P 500 has been in a 30-year upward channel. At market peaks, these stocks often reach attractive valuations and then excel in performance during economic crisis. While the spotlight has been in historically expensive mega-cap technology companies fueled by AI developments, the healthcare sector is poised to be among the primary beneficiaries of such technological advancements. The case of biotechnology industry is arguably even more compelling. Since 2015, these companies have drastically underperformed the S&P 500 and NASDAQ indices. The NASDAQ Biotechnology Index, which includes larger and established businesses, currently has a price-to-sales multiple of approximately 5.5 times, down from nearly 13 times back then. So expensive for the healthcare. He's using a ratio, which you're supposed to do. Healthcare versus S&P, you can see that we are at a very low level for the healthcare sector. This might be a good spot to be looking at healthcare stocks. Now, I'm pretty mega bull on commodities because of the valuations against the S&P, but one could make an argument that healthcare sector could be another sector to look at with this undervaluation against the S&P 500. But again, everything is undervalued compared to the S&P 500 because it is so overvalued. Here's a ratio chart. Last time this ratio chart bottom, big picture, a massive bull in mining started. It has been 22 years since last time. It should be time again since platinum is setting up often shows the way for big moves. Now, here's another thing. Platinum is cheap against all of the other precious metals. Platinum becomes cheap against other precious metals when you have low inflation. As inflation kicks up, we are going to see a breakout of platinum against all the other metals, like we are seeing here in this chart. Platinum is going to start to outperform palladium, it's going to outperform gold, it's going to outperform hopefully silver as well, to outperform all the metals in an inflationary move. It is starting to do that. It is putting in chart patterns that hopefully platinum is going to outperform. Why do I say hopefully? I say hopefully because nothing's 100%. It's not nothing's 100%. But historically, the outcomes, the probabilities is that platinum outperforms in an inflationary environment. We're in an inflationary environment. Yes, it's slowed down here recently, but a second wave could be coming. That's what we're seeing the CRB index, the oil price, all that stuff is interconnected, and we can see a big move to the upside for platinum outperforming. Platinum is the most inflation sensitive precious metal. To be a good investor, you need to know those things. So, yeah, I think we're going to see a big outperformance of platinum. Here's PDV. He says taxes contribute 79% to every $1 of bread. That's crazy. There's taxes everywhere, guys. And just to kind of say this, let's start with the grain. The land it was grown on pays taxes. The farmer pays taxes to buy, lease, and own all farm equipment. He pays taxes on each employee. He pays taxes on, when he sells his crops to the processing plant, who in turn pays taxes for the land, building, all equipment, all employees, plus on every dollar he makes when he sells his flour to the baker. The baker must pay taxes on his building, equipment, and employees. He then ships the finished product to the supermarket, who again pays taxes on the land, equipment, and shelves, every employee, and all profits. And just to say that too, when he ships it, the shipper also pays taxes on all employees, taxes on the buildings, equipment. He pays taxes on the gasoline as well, just to let you know. Add in all of the costs of shipping plus gas tax from one processor to the next. Okay, they captured that. And government increased the cost of that one product by quite a bit. But you're going to tell me it's the fault of the greedy corporations that prices are high. When is government greed ever discussed? Seems to me they have the biggest pockets of all. So I was trying to tell someone this as well. I think they added it all up. So 79 cents to every $1 of bread. You could attribute that to everything in the entire supply chain. I would say we are probably taxed about 79%. So taxes account for 79%. Everyone gets taxed that amount based off of the corporations and all the things in the middle of all these taxes. Seth Clearman on the current market says, this is one of the weirdest environments in over 40 years I've been in the investment business. People have short memories. It would be wise to think back to 74, 75 when everything didn't get rescued and to imagine a bear market that didn't immediately lead to buying opportunity. An investor must think about cyclical change like Graham and Dodd did, but now secular change as well. The combination of that has made finding mispricing harder and requires digger deeping. He's talking about the secular change in interest rates and the potential move of a secular change in the stock market and commodities. The nature of most Wall Street innovations is they're never stress tested for rainy day. That wouldn't be any fun. When the market is more expensive than historic averages, You can lose a lot to simple mean reversion. He's talking about the regular stock market there. Warren Buffett wrote that no one should own common stocks who's not comfortable with a 50% drop in the market. Almost nobody is comfortable with a 50% drop in the market, yet Americans own more stocks than ever before. I think people have forgotten that admonition. A great misunderstanding in recent years is that if you accept illiquidity, you automatically get a higher return. In reality, buying at a discounted price provides the higher return, and we don't have the discounted price in the stock market. A rude awakening could happen for a lot of people. Commodities still looking strong to me. We've got a breakout here. This is wave one, the pullback, and then hopefully we get wave three that comes, where commodities vastly outperform and inflation kicks back up. This chart was posted on my trading view from Puka Charts. Real estate is the driver, and it looks strong as bull. Here we are driving up. We can see the S&P 500 is slightly linked to the U.S. homebuilder ETF XHB, which looks like we could potentially break into the upside. Dollar weakness with gasoline up 38% since December. File not under deflationary. File not under not deflationary. Yeah, so oil futures looking fantastic for a move higher. But that's where I'll end it, guys. That's where we're going to end it for today. And give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Again, the 50% coupon code if you guys want to try it. Code Happy Birthday is going to be ending soon. So better sign up here today. I think it ends tomorrow. And if you want to join and try that. But that's what we've got for today, guys. We'll catch you later. This is Finding Value.